Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today we are going to put focus on factor-based mutual fund investments. It is different from fundamental investing. Factor-based funds are funds that use a single factor or a combination of factors to build the portfolio. What are these factors? To decode this and understand these funds, and also understand the difference between fundamental investing and factor investing, and whether this particular investment style is seeing a lot of growth. Let's get in our experts on the show today. We have with us Nisreen Mamaji, the founder at MoneyWorks, and Bharat Lahoti, co-head factor investing at Edelweiss Mutual Fund, joining us now. Nisreen and Bharat, thank you so much for joining us today. Bharat, let me come to you first up, because we usually say go the fundamental way, use fundamental investing when it comes to any sort of asset class. But what is factor investing? What are some of the factors which are considered in this case?
Thank you for calling me on the show. Just to come back to factor-based investing, it's not a new concept. If you look at it, what is factor-based investing? One is to understand what are factors. Factors are primarily stock attributes that drives the performance of the stock. It could be as simple as that a company is growing, the growth becomes a factor. If company is trading at a below intrinsic value, value becomes a factor. If company is delivering higher ROEs, the quality becomes a factor. So if you look at it, factor-based investing is similar to fundamental-based investing, where we are looking for certain attributes which drive the performance. It is not only for picking up the stock, it is also for asset allocation. Whenever the asset does well, you try to understand what is driving the asset allocation, which asset is doing well. And consequently, you can build portfolios not only from equity perspective, but across asset classes. You can build portfolios through factor-based investing.
Okay, makes sense. Thank you for breaking that down for us. Nisreen is also joining us now. Nisreen, your take here. Of course, we know some of the, as Bharat also mentioned, it's a century-old practice, but have the factors changed over time? How can you break that down for us?
Sure. So, there are various kind of factors. There are macroeconomic factors and there are style factors. So macroeconomic can be, economic growth, like exposure to the business cycles. Real rates, what is the risk of the interest rate movements? It can be also inflation, exposure to changes in price, credit risk, like default risk for, lending to companies, emerging market, political and sovereign assets, and liquidity, if you have illiquid assets in your portfolio. But the style factors are the more important, which is basically, index and ETF related. Are they passive funds or the index and ETF funds outperforming the index? Now here, basically, we look at, a couple of factors. One is value. Now, when you pick stocks that seem to be cheap based on certain measurements, like price compared to earnings. Now, inexpensive compared to the attributes, that is a low PE, does well in, say, a recovery market. So you can invest in a value kind of a strategy or a value factor investing in a recovery market. Then you have size, whether you're investing in a smaller company because they grow faster than a bigger company over a period of time. So another factor that you can consider is size. Okay. You can also look at momentum. Now, momentum is, when you choose stocks that are doing very well recently because they might continue to do well in the longer frame. Now, a price momentum catching up onto the short-term winners does very well in a bull market. And so typically, you will look at the 6-month return, the 12-month return, and your standard deviation will be, say, for a 12 months. So when you look at that and then you create a portfolio based on momentum stocks, that would be considered momentum factor investing. Oh. You can also look at quality, like, investing in companies with a strong financial health, steady earnings, good management. These are typically non-cyclical in nature when they're looking at high profit and low debt. Or you can be looking at volatility, like you have a low vol product where you select stocks based on, which don't have a very high price swing because they tend to be safer. There's not much volatility. The highest price stability will be the standard deviation, will be the least. Then that does well across market conditions typically. It will have a stable balance sheet, which are non-cyclical, such as health, IT, or consumer. So these are typically the stocks that can belong to a low volatility product. So you can also have dividend yield, where you pick up companies according, which are paying higher dividend, which can mean better returns. Okay. Now, a value index will, yeah, go ahead.
No, of course, no. That is very well explained actually, Nasreen, all the points that one can look at while they're looking at factor-based investing as well. And Bharat, you have expertise in this as well. So can you tell us, is it safe to say that fundamentals, growth, stock-specific details are not the only reasons to invest in a particular stock, a particular name? Is that what factor investing suggests in this case?
It spoke about its earnings growth, valuation, margins improvement. There are other behavioral factors also, like the other guest spoke about momentum, low wall. If you look at during periods of uncertainty, most of the investors flock towards safety stocks which displays low volatility. And consequently, that is the driving factor for the performance during that period of time. In periods of bull market, you would see actually momentum factor does extremely well. So these are behavioral factors, nothing to do with more about the financial parameters of the company, but it's more to do with how investor reacts to the news, information, and consequently the performance gets driven because of that.
Makes sense. So Bharat, what works better than return-wise? Fundamental investments or factor-based investments? How do fund managers choose which way to go about it?
So fundamental or factor-based investing, both approaches have some similarities and some differences. If you look at similarity, both of them actually are looking same numbers, whether it's earnings growth, margin improvement, return ratios, valuation. So broadly, if you look at it, both are using same stuff. What is different in fundamental investing is people look in terms of depth of analysis of management, how much management is able to deliver or not. Can they make a judgmental call on management? They also look at the products in terms of what is the longevity of the product which the company is building out. As compared to the factor-based investing, if you look at it, it actually quantifies some of these growth parameters which management is talking about. Whether the product which management has introduced in the market has that led to increase in market share. If you are able to quantify it and look at earnings growth, then you will be able to invest. So if you look at it, it's more a systematic way of doing things rather than a judgmental way of doing things in factor-based investing. In terms of return-based, if you look at it, what does well to that extent, on a longer run, both factor-based investing and fundamental investing will deliver similar kind of performance. But when you look at from a risk-adjusted perspective, factor-based investing does far more better when you look at it. Because if you look at it, it gives you a more smoother ride because you are actually tuned to many set of factors, not only growth, quality, value across time periods. And hence that gives you a better, smoother ride.
Okay, makes sense. So Nasreen, now Bharat explained what do fund managers look at, whether factor investing or fundamental investing. But how does an investor choose which type of fund should they go for? What have the returns looked like here if we compare both the categories?
Basically, I just like to add to what Bharat said is like fundamental investing is more like a detective. You dig deep into the company's financial health, market position, competition, and the management to find its true value. Factor investing, on the other hand, uses specific rules and historical data to choose between these investments systematically. So, fundamental investing will rely on, say, like an in-depth analysis of the individual companies, can spot opportunities that rules-based method might miss. But skilled investors can sometimes pick up these undervalued stocks and do really well. But by and large, I think the retail investor would do very well to invest in a factor-based kind of a style, because there you will get specific traits. You can try, like I've mentioned, 4 traits earlier. You can get better returns, which has been proven historically over the benchmark and the indices. You can reduce your risk and you can balance your investments. So for example, if you select a 50-50 ratio between, say, a momentum style and a low vol style, you will typically cover all the stocks possibly in the universe in Nifty 200, and you will also not have any stock duplication. So by adopting a complementary style like momentum as well as low vol, you can do a 50-50 in both of these for the retail investor. That makes a lot of sense. And you can still beat the market returns by at least 6%. So your alpha will be 6% in nearly 99 to 100% of the cases over a 5-year period if you compare with the Nifty 100, just the index. So, both have their strengths, fundamental as well as factor, but you have to get into your own risk tolerance, your own goals, and, the time period that you're investing for. so that the investor himself will be able to analyze whether his goal is, nearer or further away, his own risk tolerance, his investment horizon, and also knowledge and resources. How much time can you devote to actually picking up stocks by doing a fundamental analysis? Since you won't be able to, because, by and large, through experience, one can say that the investors will not be able to devote so much of time to doing a fundamental analysis. So they are better off investing into factor investing products and selecting a ratio between two very well-proven styles like momentum and low vol.
Okay, all right. That's a very interesting answer and a very interesting conversation as well. But we'll have to take a quick break. On the other side, we'll continue our discussion with our guests on factor-based mutual fund investments.
All right, so in case you've just joined in, there